Something just happened in the gold market that is not supposed to be possible, and the people whose job it is to explain it to you have gone very quiet. Not because they missed it, because they understand exactly what it means, and they would rather you kept staring at the daily headlines than lift your eyes and look at the whole map. There is a rule, an old rule, a rule that has governed this metal for about half a century, through every Fed chair and every crisis and every boom. And that rule just broke. If you are holding gold in your retirement account right now, or you have been thinking about it and something keeps pulling you back to the question, I want you to slow down and really hear this one. Because what broke is not a headline, it is the machinery underneath the headlines. And by the end of this, you're going to understand something about your savings that the big banks and the financial channels are working very hard to keep vague. So let me give you the concrete thing first, before I earn any more of your patience. For roughly 50 years, one relationship held almost like a law of physics. When the return you could earn on safe government bonds went up, gold went down. When real yields rose, gold was supposed to fall because gold pays you nothing, and why hold a rock that pays nothing when a bond will pay you a real return? That was the deal. That was the rule the whole industry was built around. And recently, gold has climbed anyway, even as those real yields have stayed stubbornly high. The old inverse rule simply stopped working. The needle moved the wrong way, and it kept moving. Now, to understand why that matters, you have to go back to where this whole experiment started. About half a century ago, the United States did something that had never been done at that scale. It cut the dollar loose from gold entirely. For generations, the dollar had been a claim on something real, metal in a vault, and the world's currencies were pegged, through a post-war arrangement, to that gold-backed dollar. And then, over a short span in the early 1970s, that link was severed. The gold window was closed, the pegs were abandoned, and for the first time in the modern history of the world, every major currency on Earth was backed by nothing but a promise and a printing press. That is the 50-year pattern, not a chart pattern, a monetary pattern. We have been living, all of us, our entire adult lives, inside a single unbroken experiment. Pure paper money, unanchored, for about half a century. And gold has been the quiet scoreboard the whole time. When that anchor was first cut, gold was priced at a level that today sounds almost fictional, a few dozen dollars an ounce. Within that same decade, it multiplied many times over, running from those low double digits to over $800 by the end of the 1970s. That was the market's first verdict on unbacked money, and the establishment hated it. So they answered it. A Fed chairman took interest rates up into the high teens, numbers that would be unthinkable today, and he did it deliberately to break the back of inflation, and with it, the back of gold. And it worked. A bond that pays you a real return, a genuine reward above inflation, is the only true enemy gold has ever had. Give people that, and they will leave the metal. For the better part of 2 decades after that, gold went to sleep. The financial world declared the whole thing over, a relic, a barbarous leftover from an unenlightened age, and a generation of savers was quietly taught to sneer at it. Here is what I need you to see, because this is the through line. That entire 50-year stretch, the boom and the bust and the long sleep and the comebacks, all of it obeyed the same underlying logic. Real yields up, gold down. Confidence in paper up, gold down. The system could always, in the end, offer you enough of a real return on its paper to make you forget about the metal. That was the leash. That was the mechanism. And the trading desks and the big banks understood that leash better than anyone, because being on the right side of it is how a great deal of money got made. And that is exactly the leash that just snapped. Recently, real yields have stayed high, the kind of high that for 50 years would have buried gold. And gold went up, not sideways, up, toward and past record territory. The bond is paying a real return again. The old enemy is back on the field, and the metal did not care. For the first time in the entire life of this paper money experiment, the leash pulled and the dog did not follow. Ask yourself, honestly, what has to be true for that to happen? What has to have changed underneath the surface for a 50-year rule to just stop applying? I will tell you what changed, and it is the part they really do not want framed this way. The buyers changed. For most of this half-century, the marginal buyer of gold was a nervous individual, a fund manager hedging, somebody reacting to fear, and that buyer could always be talked out of it by a high enough yield. But the biggest buyers on earth today are not nervous individuals. They are central banks. The same institutions that print the paper are quietly, steadily, converting that paper into metal. For 3 straight years, the world's central banks bought gold at a pace not seen in generations, more than 1,000 tons a year, roughly double what they were buying the decade before. And they are doing it at these high prices, without flinching, because they are not trading for a quick gain. They are diversifying out of paper promises. That is a different animal entirely, and it does not respond to the old leash. Let me pause here, because if you have been listening closely, a cold feeling may be settling in, and I do not want you to sit in it alone without knowing there is a door. If the people who issue the currency are themselves trading it for metal at record speed, that tells you something about how much confidence they truly have in the paper in your own accounts. And here is the part almost nobody spells out for an ordinary retiree. There is a completely legal, established way for you to do the very same thing the central banks are doing inside the retirement account you already have. You can move a portion of a 401k or an IRA into physical gold and silver, real metal, without triggering taxes and without an early withdrawal penalty, through what is called a self-directed precious metals IRA. This is not some exotic loophole for insiders. If you have $100,000 or more in any retirement account, this is squarely for you. Put together a free guide that walks through exactly how it works. Plainly, no pressure. If you are watching this on your television, just scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com. Take a look, and then come right back, because the next piece is the one that ties this whole thing together. Now, why would a central bank suddenly want metal it cannot earn interest on, at prices it has never paid before? Part of the answer is a lesson the entire world watched get delivered a few years ago, when one major power had its foreign reserves frozen, effectively locked up by other countries with the flip of a switch. Every finance minister on the planet learned the same thing on the same afternoon. Reserves held as somebody else's paper are only yours until that somebody decides otherwise. But gold sitting in your own vault, in your own country, cannot be switched off from a keyboard on the other side of the world. It cannot be frozen. It has no counterparty. And from that moment, the buying accelerated. I am not making a political point here. I am making a monetary one. The safest paper on earth revealed that it had an off switch, and the people who manage nations responded by reaching for the one asset that does not. And here is a piece of history the financial channels almost never bring up, because it punctures the comfortable idea that your money is a fixed, permanent thing. Long before this 50-year experiment even began, a government simply decreed, overnight, that the dollar was worth far less gold than it had been the day before. In one stroke, by law, the price of gold in dollars was revalued upward by around 2/3. Nothing changed about the metal. What changed was the value of the paper, and it changed because a handful of officials decided it would. That is the deeper truth underneath all of this. Paper money is a policy. It can be adjusted, diluted, and repriced by decision, and it has been, over and over, across centuries. Gold cannot be repriced by decree, because it is not anyone's liability. When you understand that, you understand why the serious money treats the metal not as a bet on a price, but as a way out of somebody else's decisions. And the pressure to make exactly those kinds of decisions has never been greater than it is now. Look at the debt, not just the government's, but the whole global mountain of it, sitting at record levels, many times the size of the entire world economy. When a nation owes that much, the temptation is always the same, and it is always quiet. You do not default in the dramatic way. You let the currency lose value slowly. You keep the cost of borrowing lower than it honestly should be, and you inflate the burden away over years, while savers absorb the loss without quite noticing. That is not a conspiracy theory. It is the oldest tool in the drawer, and the people who run central banks know it better than anyone, which is precisely why they are the ones quietly buying gold. They are hedging against the very policy they may one day be forced to run. Read that again. The issuers of the paper are protecting themselves from the paper, and almost no one is saying that to you plainly. And it has gone further than most people realize. Gold has quietly climbed the ranks of the world's reserves, passing the euro to become the second largest reserve asset that central banks hold, behind only the dollar itself, according to Europe's own central bank analysis. Sit with that. In a world of digital everything, of instant currency and infinite paper, the second most trusted store of value among the institutions that run the global system is an ancient yellow metal you can hold in your hand. That did not happen because of a chart. It happened because after 50 years of the experiment, the professionals who manage trillions are voting, quietly, with real money, on whether pure paper can be trusted forever. Here's the part that actually changes things, and it is where I need you to lean in, because almost nobody on the financial channels will connect these two dots for you. The broken correlation and the central bank buying are not two separate stories. They are the same story. The old rule, real yields up, gold down, only worked in a world where the marginal buyer could be bribed out of gold by a good enough return on paper. Central banks buying for protection cannot be bribed out because they are not in it for the return. So as they became the dominant force, the leash lost its grip. The rule did not break by accident. It broke because the reason people hold gold changed, from chasing a gain to refusing to be frozen, inflated, or switched off. And once the reason changes, the old math no longer describes the market. You have watched this system flinch before. You just may not have named it. There was the year a mere hint that the Fed might slow its money printing sent a tremor through everything, and gold took a hard hit that year, down sharply, on nothing but a rumor about the pace of paper. There was the moment a regional banking scare reminded ordinary savers that a bank deposit is not money in a safe, it is a loan to a bank, and gold jumped as people relearned that lesson overnight. Again and again across this half century, the same truth surfaces and gets buried, surfaces and gets buried. A deposit is a promise. A bond is a promise. A currency is a promise. And gold is the one thing on the list that is not somebody else's promise to keep. I want to be honest with you, the way the financial channels never quite are, because your trust matters more to me than a dramatic story. This is a case. It is not a guarantee. And nothing I am telling you is personal financial advice for your specific situation. Gold does not go up in a straight line, and it never has. Even in that ferocious run half a century ago, the price got cut nearly in half in the middle of the bull market before it went on to multiply many times over. And a lot of good people got shaken out at exactly the wrong moment because they could not stomach the drop. The exchanges can raise the cost of holding a position and knock the price down for days while nothing real has changed. Volatility is not a sign the thesis is wrong. It is the toll the metal charges, and it has always charged it. So what does that mean for how you actually hold this? It means own the real thing, the physical metal, not a paper claim that promises you metal, because a promise is exactly the thing this whole story is about distrusting. It means size your position so that a sharp, scary drop can never force you to sell, because the people who get hurt are almost never the ones who were wrong about the direction. They are the ones who were right but got shaken out at the bottom. And it means when the shakeout comes, and one will, you do not hand your metal to the very desks that engineered the fear. You decided why you own it before the storm, so the storm cannot make the decision for you. Now, here is the piece I have been saving, the recognition moment, and I want you to really receive it. Look at who is already positioned. The central banks are buying hand over fist. The old correlations are breaking in plain sight. The smart, quiet money understands that a 50-year rule does not just stop working for no reason. And yet, turn on the mainstream financial coverage and you will find gold treated as a curiosity, a sidebar, a thing your brother-in-law is into. The pension funds are barely in it. The financial media has not caught on, or will not say so. That gap between what the biggest and best informed players are doing and what the crowd has noticed is not a problem. For you, it is the whole opportunity. Because by the time this is obvious, by the time it leads every broadcast and every advisor in the country is finally recommending it, the easy part will already be behind us. Nobody is going to call you and tell you the pattern broke. Nobody sends you an invitation to the early part. You either see it now, while it is still quiet, or you hear about it later, after it is loud. So let me answer the question that brought you here, plainly. Did gold just break a 50-year pattern? Yes. It broke the rule that said a real return on paper could always pull people away from the metal. And it broke it because the world's most serious institutions stopped believing that paper is safe enough to be the whole story. That is not a daily wiggle. That is the scoreboard of a half-century experiment starting to tilt. And if you have worked your whole life to build $100,000 or more inside a retirement account, you owe it to yourself to at least understand what that tilt could mean for you before it becomes the thing everyone already knew. If you watched this all the way to the end, this last part is specifically for you, and I mean that. For viewers with $100,000 or more in a 401k or an IRA, I offer a free one-on-one educational web conference. No cost, no obligation, just a real conversation about your situation and whether moving a portion of your retirement into physical gold and silver makes sense for you. And let me give you the honest reason to do it now rather than someday. The right time to make a calm, clear headed decision is precisely when nothing feels like an emergency, when you still have room to think, when you are not reacting to a panic on the news. That window, the quiet one, is open right now. Once it is obvious to everyone, it is no longer calm and it is no longer cheap. So if you were watching on your television, scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com. Book the conversation. Mention that you watched this all the way through and let us talk it through together. Because the rule that governed this metal for 50 years just broke. The biggest, most serious money in the world already knows it. The only real question left is whether you understand it while it is still quiet, or whether you find out the way most people always do, after the easy part is gone.